Hello, good evening. This is the continuation of our lesson on ratio analysis, and here we have the same sample financial statement to be used in computation. So this is the same financial statement that we used in the previous upload of video. And then, so we begin. We have the inventory turnover, whose formula is given as cost of goods sold average divided by inventory. So we have 200,000 divided by 350,000, and we get a rate which is equal to 57.1%. Then we have the days in inventory, whose formula is given as 365 divided by inventory turnover. So this is equivalent to 365 divided by 0.571. 0.571 is the decimal equivalent of the rate, which is 57.1%. So here we get a value of 639.2, and that is the number of days. Okay? And then we have the accounts receivable turnover, whose formula is given as net sales divided by average accounts receivable. So we have the net sales equivalent to 1 million divided by 500,000, and we get a value of 2. So accounts receivable turnover. Now next, we have the days in accounts receivable, and this formula is given as 365 divided by accounts receivable turnover. And we know that accounts receivable turnover is equal to 2. So we divide 365 by 2, and we get a value which is 182.5. Okay? Next, we have the debt to equity ratio, whose formula is given as net income divided by average equity. And so we have 900,000 divided by 870,000, and this is equal to 1.03. Then we have the debt ratio, whose formula is given as total debt divided by total assets. And so 900,000 divided by 1,800,000. And so we get a value or a rate which is equal to 50%. Then we have the interest coverage ratio, whose formula is given as operating income divided by interest expense. And this is given as 500,000 divided by 30,000, and we get a value which is equivalent to 16.7. And then we have the current ratio, current assets divided by the current liability, and we have this 1,150,000 divided by 400,000, and we get a value which is equal to 2.88. Then we have the quick ratio. Quick ratio's formula is given as cash plus accounts receivable divided by current liability. And this is 300,000 plus 500,000 divided by 400,000, and we get a value of which is equal to 2. Then we have the accounts receivable turnover ratio, whose formula is given as accounts receivable divided by the average asset. And then this is equivalent to 500,000 divided by 1,800,000. And we get a rate which is equal to 27.78%. That's it. Thank you. Bye.